Number 1. Budgeting.
Budgeting is the process of creating a spending plan that helps you manage your money effectively. It involves identifying your income and expenses, and allocating your funds accordingly to ensure that you live within your means. Here are some steps to follow when creating a budget. Identify your income. List all sources of income, including your salary, bonuses, and any other sources of income. Track your expenses. Keep track of all your expenses for a month, including rent, mortgage, utilities, groceries, transportation, entertainment, and any other expenses. Categorize your expenses. Once you have tracked your expenses, categorize them into necessary expenses, rent, mortgage, utilities, groceries, and discretionary expenses, entertainment, eating out, shopping. Determine your spending limits. Based on your income and expenses, determine how much money you can allocate towards each category. Monitor your spending. Keep track of your spending throughout the month to ensure that you are staying within your budget. You can use a budgeting app or spreadsheet to help you track your spending. Make adjustments. If you find that you are overspending in a particular category, adjust your budget accordingly. You may need to cut back on discretionary expenses or find ways to increase your income. Remember, creating a budget is just the first step. The key to successful budgeting is to stick to your plan and make adjustments as needed. By sticking to a budget, you can achieve your financial goals and live within your means. Number 2. Savings. Saving is a crucial part of financial management. It involves setting aside money for emergencies, future expenses, and long-term goals like retirement. Here are some tips to help you save money. Set a savings goal. Determine how much money you want to save and by when. Having a specific goal can help you stay motivated and focused on your savings plan. Create a budget. A budget can help you identify areas where you can cut back on expenses and allocate more money towards savings. Automate your savings. Set up automatic transfers from your checking account to your savings account each month. This way, you won't forget to save and you'll be less tempted to spend the money. Reduce your expenses. Look for ways to cut back on unnecessary expenses, such as eating out less, using coupons, and shopping for sales. Increase your income. Look for opportunities to earn extra money, such as taking on a side hustle, selling items you no longer need, or asking for a raise at work. Use a high-yield savings account. Consider opening a high-yield savings account that offers a higher interest rate than a traditional savings account. This can help your savings grow faster. Remember, saving money is a long-term process. It requires discipline and patience, but the benefits of having a healthy savings account can be significant in times of emergencies and reaching your long-term financial goals. Number 3. Investing. Investing is the act of putting money into assets with the expectation of earning a return or profit. Here are some basic concepts to consider when investing. Diversification. Diversification is the process of investing in different types of assets to reduce risk. By investing in a variety of assets, such as stocks, bonds, and mutual funds, you can spread your risk and minimize the impact of any one asset on your overall portfolio. Risk versus reward. All investments involve some degree of risk. Generally, the higher the risk, the greater the potential reward. Before investing, it's important to consider your risk tolerance and investment goals. Asset allocation. Asset allocation involves dividing your investment portfolio among different asset classes. The allocation will depend on your risk tolerance and investment goals. Time horizon. The length of time you plan to hold an investment is an important consideration. Generally, investments that are held for longer periods of time have a higher potential for returns. Fees. It's important to consider the fees associated with an investment, such as brokerage fees, management fees, and expense ratios. These fees can eat into your returns over time. Research. Before investing in any asset, do your research. Understand the company, industry, or asset you are investing in and consider factors like market trends, economic conditions, and the competitive landscape. Remember, investing involves risk and requires a long-term perspective. It's important to have a well-thought-out investment plan and to regularly review and adjust your portfolio as needed. If you are new to investing, consider working with a financial advisor who can provide guidance and help you make informed decisions. Number 4. Credit. Credit is an important financial concept that refers to the ability to borrow money or access goods or services with a promise to pay later. Here are some basic concepts to consider when it comes to credit. Credit score. A credit score is a number that represents your creditworthiness. It is based on your credit history, including your payment history, amount owed, length of credit history, new credit, and types of credit used. A higher credit score generally indicates that you are a low-risk borrower. Credit report. A credit report is a record of your credit history. It includes information about your credit accounts, payment history, and other information related to your creditworthiness. You are entitled to a free copy of your credit report from each of the 3 major credit reporting agencies once a year. Interest rates. When you borrow money, you will be charged interest, which is the cost of borrowing money. The interest rate will depend on your credit score, the type of loan, and other factors. Credit cards. Credit cards are a type of loan that allows you to make purchases and pay for them later. Credit cards can be a convenient way to access credit, but it's important to use them responsibly and pay off your balance in full each month to avoid accruing interest. Debt. Debt refers to the amount of money you owe to lenders. It's important to manage your debt responsibly and make payments on time to avoid damaging your credit score. Credit utilization. Credit utilization refers to the amount of credit you are using relative to your credit limit. A high credit utilization ratio can negatively impact your credit score. Remember, credit is a tool that can help you achieve your financial goals, but it should be used responsibly. Make sure you understand the terms and conditions of any credit product you use, and regularly monitor your credit report to ensure that it is accurate. Number 5. Insurance. Insurance is a financial product that provides protection against risks and potential financial losses. Here are some basic concepts to consider when it comes to insurance. Types of insurance. There are many types of insurance, including health insurance, life insurance, auto insurance, homeowners insurance, and disability insurance, among others. Each type of insurance provides protection against different types of risks. Premiums. A premium is the amount of money you pay to an insurance company to purchase coverage. Premiums can be paid monthly, quarterly, or annually. Deductibles. A deductible is the amount of money you must pay before insurance coverage kicks in. For example, if you have a $1,000 deductible on your auto insurance policy and you get into an accident that causes $2,500 in damage, you will be responsible for paying the first $1,000 and your insurance company will cover the remaining $1,500. Coverage limits. Coverage limits refer to the maximum amount of money an insurance company will pay out in the event of a claim. It's important to choose coverage limits that are appropriate for your needs and risks. Exclusions. Insurance policies may include exclusions, which are situations or circumstances that are not covered by the policy. It's important to understand any exclusions in your policy before purchasing coverage. Claims. If you experience a loss that is covered by your insurance policy, you can file a claim with your insurance company. The insurance company will investigate the claim and provide compensation if the claim is covered by the policy. Remember, insurance is an important tool for managing risk and protecting your finances. It's important to choose the right types and amounts of insurance coverage to meet your needs, and to regularly review and update your coverage as necessary. Number 6. Debt. Debt is an amount of money owed by an individual, business, or government to a lender or creditor. Here are some basic concepts to consider when it comes to debt. Types of debt. There are many types of debt, including credit card debt, student loan debt, auto loans, mortgages, personal loans, and more. Each type of debt has different terms and conditions, including interest rates, fees, and repayment schedules. Interest rates. Interest is the cost of borrowing money, and interest rates can vary depending on the type of debt and the borrower's creditworthiness. A high interest rate can make it more difficult to pay off debt and can lead to increased financial stress. Payment schedules. Debt is typically repaid over a set period of time, with regular payments due at specified intervals. It's important to understand the repayment schedule for each debt and to make payments on time to avoid late fees and other penalties. Debt-to-income ratio. Your debt-to-income ratio is the amount of debt you have relative to your income. A high debt-to-income ratio can make it more difficult to qualify for loans or credit in the future. Credit score. Your credit score is a measure of your creditworthiness, and it can be impacted by your debt. High levels of debt, missed payments, and other negative credit events can lower your credit score and make it more difficult to access credit in the future. Debt management. If you have high levels of debt, it's important to have a plan for managing and paying off your debt. This may involve strategies like consolidating debt, negotiating with creditors, and creating a budget to prioritize debt payments. Remember, debt is a tool that can help you achieve your financial goals, but it should be used responsibly. It's important to understand the terms and conditions of any debt you take on, and to have a plan for paying off debt in a timely and manageable way. Thanks for watching.